franchisees rather have been looking for as well. You know, things that are easy to make, boost sales additionally, and who doesn't like to grab, you know, a quick donut on the way out with their coffee? We know people are snacking more and also leaning more into beverages post-pandemic, and this could be, you know, a good move for both companies here.
Kate, thanks so much for joining us with that story.
Thank you.
And coming up, the growing value of tech infrastructure. CFRA out with a new note detailing some of the possible long-term winners of the AI boom. Plus, direct deals on the rise, private equity moves climbing from $6 billion in 2019 to $31 billion in 2023. We'll talk more about that underexplored section of the economy when we return.
Yeah, damn. Sorry about that. I've got Streamlabs, like multiple instances running in the background, like 2 or 3 instances of Streamlabs, and it keeps kicking the stream down. I had to find them all and end them. Yeah, I know. I'm like, it's not you. It's Streamlabs. I use OBS, and I should be using Streamlabs. There's 2 versions of Streamlabs. I'm using the wrong version. I'm using like the Windows versus the Linux version, and I should be using the Linux version of Streamlabs.
Download the app. Welcome back to Power Lunch. Mega cap tech stocks have dramatically boosted investments in recent years and are showing no signs of slowing down, according to a new note from CFRA Research. Amazon, Alphabet, Meta, and Microsoft are expected to spend more than $175 billion combined this year, with even more expected in 2025. Joining us now is the author of that research note, Angelo Zeno. He's the Vice President and Senior Industry Analyst at CFRA Research, covering tech, hardware, software, and semiconductors. So, Angelo, tell us what is driving the spending this year. Is it all about AI?
Well, I mean, that definitely is a big part of it, right? So when we kind of look at the CapEx environment here in 2024, we're looking for growth of about 25% or so. That actually follows a year in 2023 where it was roughly flattish or so. The last time we actually saw a flat kind of CapEx environment was about 2018, 2019, and we all know what drove kind of CapEx thereafter, and that was, you know, a very strong pandemic. And you kind of look over here into 2025. Our view is low double-digit growth. Of course, the AI spend is going to be a big driver of that, but just an overall recovery in kind of server spending will also help that. When you kind of think last year, we actually saw a sharp decline in terms of server spending overall. And a big reason for that was just because of the digestion that we needed to see in terms of some overcapacity on that side of things. But kind of looking ahead, it's going to be AI driven. It's going to be kind of just your natural data growth that we've seen kind of over the last 2+ decades out there, growing north of 20% at an annualized pace. And then ultimately, it's just improving free cash flow growth from each one of these companies. I mean, when you kind of look at the fundamentals for each of these companies, extremely strong in nature, and that's going to drive higher spend, we think, has historically been the case.
But this also comes after Meta had its year of efficiency and then just said, going forward, we want to operate as leanly as possible. And we heard similar messages from other tech giants. They're trying to be lean, and they're also trying to chase AI growth. I guess the question is, after this big sort of bounce back in growth you expect this year, are we really going to be able to see such sustained growth rates as these companies try to be more efficient with that capacity and rein in costs?
Well, so I actually think the efficiencies are actually supporting kind of the CapEx spend out there, right? When you kind of think about what happened from 2022 into 2023, to your point, each one of these companies really focused on those cost efficiencies, actually improved the profitability metrics of their individual companies. That has actually improved the free cash flow potential going into 24 and into 2025. So again, our view is we're looking for, is this CapEx spend sustainable? We think so. The magnitude of the spend isn't sustainable in terms of 25% plus growth, but we do think 10 to 13% growth is sustainable going into 2025. A
big question here is, can the bulls turn this on? If bulls can't turn this on, if there's a rejection right up here, we are going to blood the fuck out of this. And not only will we blood this out, so if we reject this up here, and at the end of the day here, we're coming into 218 right now. We get into that power hour. We can't do that shit. We will blood this straight down. Whatever bounce we get into 4 p.m. will be sold off tomorrow if that takes place. And we will red bar the entire day tomorrow. And the reason that I say that is because these last 2 days before end of quarter, we get huge outsized moves. So this is going to be a big moment here for the market. Does it reject, or does it, if we reject and head down and start like a 2-day bear cycle, big one, like big moves to the downside, or is the market quote unquote saved and we get these huge moves to the upside into the close, and then a continuation on into the first week of April? So traditionally, hold on, let me get this, give me a second, I mute this CNBC shit here. Hold on, let me turn some of this stuff on here. Go on a second, guys. What do I got here? Old timey man, still break time. There we go. And let me see. We got more other break time here. Break time. Be right back. So just a heads up here. Traditionally, let me move that over there so you can see me. See my little face. So traditionally, on these last couple days before end of quarter, well, not end of quarter, but end of quarter of that month. Not OPEX, but the end of month into the first week of the next quarter, statistically, we're very bullish, especially in a bull run or a bull market. We tend to like rip faces off towards the end of the day. Last 2 days or so, we like rip for no reason. It's just like pure fucking to the moon, to the moon, to the moon. And it should be like 3, 4, 5 days of up. Like this would continue into next week. Now, if we can't get that done, I posted an instance of when we did not do that in the Discord. And that is where right around 1:30 in the afternoon, we started selling hard and heavy. And that didn't stop for days and days, probably I think a week or so of selling. But it's like straight fucking down. Like last hour, like 1:30 to about 3:30 in the afternoon, straight fucking down. So I'm going to, and there's one other instance. This was, I believe, maybe February of 2023. Don't quote me on this. There was one monthly end of month OPEX where we ran down 30 or 40 handles the last 5 minutes. I was expecting it at like 1:30, 2:30 in the afternoon. It didn't happen. And so I'm just sitting there waiting. And I'm like, oh, we're definitely going down. I just don't know when. And they wound up doing it like the last 5 minutes. It was straight red bars, straight down to the depths of hell. It was like last literal 5 minutes of the day. So I'm sitting here waiting for it. Whether it's up or down, I don't know. I still got calls for Friday. So we'll see what happens with all that bullshit. You could invariably trade a straddle here or a strangle in either direction with cheap options, regardless of whichever direction they pick. It would be very unusual coming into today, the end of today, tomorrow, and then into the first next week and not have some kind of a ramp or major sell-off. So you can see how they've got us pinned here right now. All day long, we haven't done shit. And I kind of figured this shit would happen today where we just kind of be pinned sideways action, get the big move up, come down, and then pin it, and then they're going to fake you out. This is pure manipulation to try to get park the bus into end of quarter. So whatever, I don't know which direction they're going. There's no real way to pick it. I'm positioned right now to the upside for that to happen. If it doesn't, I was thinking about getting a bunch of like 5-cent 0-day puts or 1-day puts for tomorrow or Friday, really low in case we do slam down 40 handles, 50 handles, something fucking stupid. But at this moment, I'm not. At this moment, I think it is up to the upside. And then I expect that weakness just at the open on Friday for OPEX, or not OPEX, for end of month hedging flows. But I am on the up. I'm up like up. We're going up. There's no reason we should go down. The only other reason I could think of to go down like that to bloodbath would be the banks wanting better positioning possibly for Q2. Might be a possibility. That's all I got for you on that stuff. There's also one other thing to consider here. Oh, I gotta get my voice back. I'm losing my voice again. There is another thing to consider here, and that is that futures don't trade this year on Good Friday. Non-farm payrolls are being released on Good Friday, and equity and rate futures markets were open for the reaction. Apparently, PCE is not a big enough deal to warrant that kind of attention. That all comes from Scott this afternoon. He's saying that in a letter that I just got a moment ago. He also mentions that volumes are low. Volumes low means we usually go up. If you didn't know that, not down, believe it or not. High volume days, people are like, high volume, man, we're going up. No, no, they're usually like dead days. Low volume days are some of our best times to rip faces off. So anyways, we'll wait and see what happens here. VIX getting crushed. There isn't a hell of a lot to talk about here. ARM, dude, did you guys see ARM get wrecked? Like, I was watching ARM earlier today. Shit was down like 7% or something this afternoon. It was looking like it was ready to sell anyways. Let's go over there and look at it. Take a peek here. So it looked like it was ready to sell there, but talk about violent reactions. Here's ARM right here, right? They came up right up here, right? And they tested this previous high. So it's normal to roll here, but just the violence in that roll is insane. And they got, what, one more back here to do? Are they going to roll violently on that one too? And then maybe come back up here and do that one? And then the other one up here. But ARM, like, I was just talking to Joe and Bork, and I'm like, dude, look at that fucking violence down there. That's 1 day of trading straight down for ARM right on there, 126.73 daily trigger. Dude, I don't even know if, would you even be positioned for, I mean, I guess you're positioned for it. You already know they're going to sell all of these peaks, and they hit one right here. Here's one right here. They hit that first one, and then we got the second one right there. A little bit more violent than expected, right? Looks like they missed it. Oh, no, sorry, I got the wrong one. It's this one right here. So they tagged this one, actually failed to tag this one, and they went straight down to the depths of hell. That's ARM, baby. Damn, dude, I wish I had puts on that fucking thing. I mean, you know it's going to roll, but this roll is violent, baby. Woo! ARM getting taken out to the woodshed today. I haven't seen that anywhere else. None of these other tickers have done that today. So anyways, we'll pay attention to SPOOs, see how it wraps up the day. And if we see any selling into the end of the close today and you want to re-short, you'd be re-shorting it down here, or not down here. Wait for the squeeze back up and then re-short it again into tomorrow. If we begin to blast up into the close, don't get caught. I would be I want to say something here. Reason I posted this earlier in the Discord. If you are a futures trader It is very dangerous for you right now. I don't care if you're a buyer, a seller, be very careful here. If you're a futures trader, Globex trader, I would be completely sitting on my hands. Even if you like 2020 hindsight and you're like, oh, I would have had it right. I was long the entire time, or I was short the entire time, I was selling futures. I don't give a fuck. This goes the opposite way against you. You're gonna get a hurting. You might as well just trade a day when none of that shit's going on. All right, I'll be back with you guys shortly. I'm gonna get back into the Discord with Bork and Joe.
For inflation, you're getting the same price of chocolate, but it's smaller. And so companies are trying to manage those costs, and they are hedged so they're not exposed to all of these price swings. But at a certain point, those costs do get passed along to the consumers, and so higher Easter candy.
So as a consumer of chocolate, I'm invested in this one. I'm particularly invested in this one. But my question is, you mentioned global warming. Does this just mean with global warming, there's going to be more volatility and prices are bound to continue to increase?
So I think the thing about this crop specifically is that it is so concentrated in West Africa, and cacao trees can really only grow 20 degrees north or south of the equator. And so they're a highly specific crop. And so what Humza Hussein was telling me was that he thinks the soil has now been permanently changed. It wasn't that it was too dry last year. They actually got too much rain in short concentrations. And so it's not ideal for these crops. But I think beyond just cocoa, we see this in special commodity, very small markets like uranium, like lithium. If they are concentrated in one area, if there's any impact in that region, it does lead to these crazy kind of out of whack price swings.
Yeah, so much risk tied to that global warming. Thanks so much, Pippa. Really appreciate it. And as we head to break, a quick power check. On the positive side, Seagate Technology, Morgan Stanley upgrading it to overweight, citing AI's potential to boost earnings. On the negative side, UPS having its worst day since its earnings in January. Despite decent results, shares are moving lower after announcing a new 1+2 plan. This is the goals of growing volume by dollar, then growing volume with a focus on margin. That's your power check. We'll be right back.
Shortly expecting comments from ECB's lane.
Do you want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service for the price of 1 month and save 92%.
NYMEX diesel April futures settle at $2.62 a gallon. NYMEX gasoline April futures settle at $2.70 a gallon. US crude oil futures settle at $81.62 a barrel. That's down 33 cents or 0.4%. NYMEX natural gas April futures settle at $1.57.
Welcome back to Power Lunch. I'm Contessa Brewer with your CNBC News update this hour. The Wisconsin Supreme Court today handed a victory to Amazon Flex workers, letting stand a lower court ruling that some of Amazon's delivery drivers should be treated as employees, not independent contractors, as Amazon had argued. The ruling says drivers in the Flex program are entitled to unemployment pay if they're laid off. The case closely watched for the broader effect the ruling could have on the gig economy. Luxury apparel company Canada Goose announced today it's cutting 17% of its corporate workforce. That move follows a string of layoffs from other retailers this year as people pull back on discretionary spending. And Buckingham Palace announced today that King Charles and Queen Camilla will attend an Easter service this Sunday. It would be the first major public appearance from the king since he was diagnosed with cancer last month. Prince William and Kate, the Princess of Wales, who's also undergoing cancer treatment, are not expected to attend. Julia, send it back to you.
Thanks so much, Contessa. Now take a look at shares of medical device maker Shockwave Medical. Shares are surging on a Wall Street Journal report that Johnson & Johnson is in talks to acquire it. Take a look there. They're up about 10%. Shockwave was briefly halted for volatility earlier this hour. Now the deal could be finalized in the coming weeks, according to the report. Now, Shockwave telling CNBC they do not comment on rumors or speculation. We've reached out to Johnson & Johnson as well.
All right, meantime, the high interest rate environment is having a big impact on private equity. The number of private equity-backed deals globally dropped to under 6,000 last year from a peak of more than 10,000 in 2021. But one so-called niche area that is growing is the number of so-called direct PE deals. Essentially, that means a capital raise for a single company outside of a traditional fund structure. More than 700 companies were acquired by private equity in this type of deal last year, compared with over 200 just 5 years ago. And the annual value of these deals, directs, has also soared from $6 billion in 2019 to more than $30 billion last year. Here on set to talk about what this means for investors is Matt Swain, CEO of the direct PE firm Triago. It's being acquired by the California investment bank Houlihan Lokey in a deal that officially will close next month. Matt, welcome. Good to have you with us.
Thank you for having me.
Let me make sure I'm understanding what a direct deal does. In a traditional private equity format, the private equity company, whether it's Blackstone or Carlyle or any of the names we know, assembles a fund of money drawn from institutions, private sources, family offices. And then they go out and they find companies to put that money to work in. Under your model, it is inverted. You find the company first that you want to target, and you then go and solicit capital from private investors, institutions, and so forth. Am I right on that?
That's exactly right. Again, a direct is raising capital around a single company outside of a fund structure. Most structures today for private equity funds are what is known as blind pool. Blind pool means that you raise money around a sector, an industry. You know the thesis behind what you're investing behind, but you don't know the actual companies that you're going to be getting exposure to. Directs turns this on its head. You are buying into a very specific company that you know will fit within your portfolio.
And the money then gets to work, I assume, quicker, because often in those private equity funds, the money can sit for a while, collecting a fee for the Blackstones of the world, but not really being productively put to work. Am I right on that?
Absolutely. Do you know how much blind pool capital is currently sitting on the sidelines?
No idea.
$3.7 trillion, more than the GDP of France. I mean, in this type of environment, you can't have that much money sitting on the sidelines, paying a fee to private equity firms. You have to be able to invest it quickly, and your money has to grow, especially with 4 or 5% type interest rates.
So walk us through some of the advantages, though, not just for investors, but also for the target companies of going this route.
Yeah, these deals are categorized more by operational value add. You know, not all private equity funds are getting it wrong. The ones that are trying to generate returns through financial leverage, they are getting it wrong. But what I would tell you is true of these private equity deals or direct deals is that almost all of them are focused on adding value to the company on a day-to-day basis. You have these managers actually moving on-site, taking interim roles at the company, trying to find customers for these assets. And that's really what characterizes these types of deals.
When you target a company that you're going to put capital into, are you targeting companies that are, quote, distressed situations, or are these successful companies that are growing and you think can grow even faster with your infusion of capital? That's question one. Question two is, are those target companies welcoming to the outside capital that you're bringing?
It's a good question. I would tell you these tend to be lower middle market buyout companies that are profitable. They have to have some type of runway of growth. If they don't have a runway of growth, quite frankly, investors aren't interested, managers tend not to be interested. This is not the best structure for them. So as it relates to number one, it's a profitable company that has a long runway where you can invest behind, usually with some type of macro tailwind.
And then in terms of what this means for the incumbent firms, the Blackstones, the Apollos, are they doing this as well, or do they see you as a threat in the fact that you're doing this?
Look, I won't comment specifically on any large cap buyout firm, but what I will tell you is they're cognizant of the space. A lot of these firms are actually looking into the space. You may have seen recently, Tyler, you just mentioned it, we just sold to Houlihan Lokey. Some of the competitors during the actual sale process of Triago were buyout firms, were these large private equity firms that want to know how to best access these type of deals. Because although the results are early,
they want to continue those kind of deals. They don't want to squash you.
They do not want to squash
because you're the goose that's killing the golden egg.
We're still a small part of the private equity fund market. We're about $31 billion of deals, whereas the private equity fund market is $800 billion of deals. But what I would tell you is there's just a lot of alpha in these deals. And if they can unlock that alpha, they want to play in that space.
Let me come back to a question. I think I cut you off before you got to answer it. Do the companies that you're targeting, those middle market firms that are profitable, that you think can benefit from the infusion, are they welcoming to your involvement or that of investors A, B, C, D, E, and F?
Yes, these deals tend to have great alignment with the existing management teams of these companies.
You're not blowing out the existing
No, almost never. We're working alongside them, and what I would tell you is characteristic of these direct deals is helping the customer base grow or helping these type of companies overcome the biggest problems that they're facing literally on that day-to-day basis. So it's actually the opposite. Usually they're waving us in with open arms.
I can't help but notice that you are hardly a gray beard. How old are you?
Around 30. How about that?
Around 30. How did you get into this?
You know what? A lot of great people in my life, a little bit of luck, to tell the truth. But in all honesty, this isn't rocket science. I mean, we noticed a macroeconomic trend of investors wanted less of a filter between them and the companies that they were investing in.
And finally, how do you make money?
We generate the ecosystem. So in short, we're banking these transactions. We are matching the buyers, which are investors, up with the sellers, which are the actual managers, taking a transaction fee and usually rolling a portion of that transaction fee into the companies going forward.
And so you invest in those companies?
Very often personally as well, yes.
All right, Matt Swain, thank you.
Thank you.
Continued good luck.
And coming up, call it a comeback. A new report from Wells Fargo highlighting the tremendous impact that women-owned businesses have had on America's post-pandemic recovery. We'll bring you the key findings when Power Lunch returns.
Brent's crude futures settle at $86.25 a barrel. That's down 50 cents or spot 5/8%.
Protect your trades from macro headline risk with Financial Juice Pro. Now only $99 a year for our real-time service.
Welcome back. The pandemic upended operations for small businesses across the country. But from those challenges, entrepreneurs did what they do best, look for opportunity. And a new report finds that women are leading the charge. CNBC's Kate Rogers is here with more. Kate.
Hi again, Julia. The data show that women seized the opportunity to launch new ventures during the pandemic at nearly double the rate of men. Data from Wells Fargo show new business starts from 2019 through 2023 were up nearly 14% for women. That's about double what we saw for men. What's more, growth rates for revenue and employment are even higher for businesses that are owned by Black and African American women, with their business growth rates outpacing the markets. Now, this is key as businesses owned by women and minorities, remember, were disproportionately impacted early on in the pandemic and were less likely to receive initial rounds of Paycheck Protection Program funding. Ruby Taylor, who is a former school social worker, runs the Financial Joy School, which aims to close the financial wealth gap and create a new generation of Black investors. Taylor has overcome not only funding challenges to launch her business, but also a traumatic brain injury in 2012 that drastically altered her life. She learned about long-term investing, she says, from the parents of a former student and got the idea to launch her business from there.
When my financial situation changed, I began to invest. And then I saw my money grow. I'm like, this is so dope. So I am on a mission to create a financially equitable world where everybody can build generational wealth no matter your income.
Now, Ruby graduated from Milestone Circles, which is a program presented by the NASDAQ Entrepreneurial Center. It's also sponsored by Wells Fargo. It helps owners find new pathways to funding. That is very key, Julia, in overcoming some of these barriers for owners, of course, as they look to grow their businesses. Back over to you.
Kate, I love this optimistic, positive news, but I wonder how it interacts with all the data we saw about women leaving the workforce during the COVID pandemic. Does this mean that women, after they left the workforce, re-entered as entrepreneurs? And how much are those two things related?
I think that they're certainly related. So the labor force participation rate for prime-aged women is still lower by about 10% than it is for men. It's nearly 90% for men right now, just under 80% for women. But we know about 1 million additional women aged 25 to 54 re-entered the workforce since December of 2019. And if you look at those new business starts at nearly 14% for women, just about 7% for men, Julia, you have to put two and two together and notice here that they are launching more and more businesses.
Do women still struggle to raise capital for their businesses?
Oh, certainly. I mean, there are definitely big gaps there in terms of women's ability to raise in comparison to men. And also, I mentioned some of the gaps that we saw with the PPP program that we covered so closely here on CNBC for women and minority-owned businesses not accessing that capital at the same rates that male-owned businesses were. But if you look at the numbers, they're really roaring back here, which is great news.
Great news indeed. Thanks so much, Kate. And
Thank
we
you.
will be celebrating CNBC's inaugural Changemakers Women Transforming Business List. That's coming up in a new event in New York City. It's on April 18th. To learn more, go to cnbc.com/changemakers or scan this QR code. And as we mark Women's Heritage Month, we are sharing the stories of some of our newly named Changemakers. Here is Priscilla Sims Brown, Amalgamated Bank President.
I think for everyone, there's that secret sauce, and I think everyone has their own superpower. You are enough. You don't have to be perfect, and you don't have to fulfill a certain mold. I have to say today, I really think a lot about the younger people, like my daughter, Faith, and so many of her friends who are taking on the world in a brand new way. I find them incredibly inspiring.
That sure then shit looks like rejection, doesn't it? That does not look good for the Bulls here at all right now. 2:48, 12 minutes to find out what's going to happen.
All right, welcome back to Power Lunch, everybody. Time for today's three-stock lunch. And here with our trades is Malcolm Etheridge, CIC Wealth Management Executive Vice President and a CNBC contributor. First up, Malcolm, welcome. And first up, Visa. Visa and MasterCard settling now a long-running lawsuit agreeing to a $30 billion settlement that is going to lower those so-called swipe fees. Shares of Visa are higher today, presumably in part because by a little bit. What's your trade on Visa, Malcolm?
Yeah, Tyler, I actually think this one is a buy, despite what you just mentioned with some of those swipe fees potentially coming down. I think Visa will figure out a way to make up the difference. There's concerns about cybersecurity. They'll always be able to offer extra protections there. So to me, Visa is the definition of a defensive stock, right? Good economy, bad economy, recession. It doesn't really matter because they sit in the middle of each one of those transactions that you and I make and collect their fee. So I think this is a great one to hold long term. And I also think it's one of the better fintechs to own, probably even safer than one of the big banks because it doesn't have that interest rate sensitivity that a lot of the financials do.
And next up, Malcolm McCormick, the spice maker benefiting as more consumers eat at home. McCormick reporting net income climbed 19% year over year, shares up nearly 10% today. Malcolm, what's your take on this one?
Yeah, so I actually like McCormick. This one has basically been beat up for about 2 years, right? They hit their all-time high in March of 2022, and they got cut in half pretty much since then. But I think McCormick is one that we should at least consider because as the markets start to get a little wobbly, we've got an election coming up. We know volatility happens in election years, and investors go seeking security. The staples will be the name, the sector, excuse me, that investors look for, and McCormick is a great one in that space that doesn't have too much trouble competing with the names like Walmart and Target that have offered their private label since the COVID pandemic caused people to go down market a little bit.
And finally, we're going to look at CVS. Amazon announcing same-day delivery of medications in New York City and Los Angeles. Plans to expand the option to other cities by year-end. It could be a threat to traditional pharmacies, including CVS. Your trade on CVS?
Yeah, so for me, CVS is a sell, partly for the reasons you just mentioned, right? But also I've heard investors make the argument that some of the acquisitions CVS has made most recently, specifically Aetna, I think is the biggest, more marquee one, should put in the bottom here in the mid-70s somewhere for CVS. But I just feel like the market for PBMs, those margins are shrinking and shrinking. And so the online pharmacies that compete against CVS have just been cutting into those margins. And then you also have to couple the fact that CVS has a shrink problem, right? They still have stores being closed due to theft. And I just don't see this turning around anytime soon. It's going to be a long, hard slog for those shares.
All right, Malcolm, thank you very much. Appreciate it. Malcolm Etheridge.
And still ahead, Peacock getting exclusive rights to stream the NFL's first opening weekend Friday game in over 50 years. We'll break down what it means for the entire media landscape when Power Lunch returns.
Gold bond.
We only have 4 minutes left in the show and several more stories you need to know. Let's get right to it. Our theme of the day is prices, starting with the price of Reddit shares on a tear following last week's IPO. It's up more than 12% today after posting a...
Come on, bulls, baby, let's do it. Start ripping faces off.
We just saw Astera also.
Come on, bulls.
Reddit went public on Thursday. These are stocks that had strong IPOs. And
I want like 40 fucking handles straight to the face.
And Reddit, they're almost a double. And we should point out that former president.
Hell yeah, dude. I'm bullish as fuck here. I'm like, what are you doing? Like, let's do this.
Media and technology.
I did this 1 month. Like there was like 1 month end where I'm sitting there. I sat there. It was like 4 o'clock. I'm like,
moving up.
It was like 3:55, and I was like, we're gonna keep the stream on until it happens. I'm like, I know it's gonna happen.
In January, this according to the.
We just sat here and sat here and sat here and sat here, and it like went straight down to the depths of hell.
Year over year. You want to guess the richest one?
This time I think it's gonna go straight up to the fucking moon though. I'm on the opposite side of that thesis today.
Santiago, 11%.
This is a pure fucking scam right here.
Pretty good. Meanwhile, Dollar Tree says it's raising its price.
I'll sit here with you. I'll sit here till 4:15 waiting for it to happen. So I'm here with you till the end.
Thanks to sky-high inflation, Dollar Tree had previously raised its price cap to $5.
Sorry, I'm doing a bunch of crap back here. I got like stupid tax shit with business and stuff.
Anything less than $1.
Can't fucking not do it. And it's like stupid. It's like just pure stupid.
And know that everything is
every state is like I gotta get this shit done. Like every state is like different.
And that's even true.
Every country is different. Every state is different. And it's just a pain in the ass.
Its price for bananas for the first time in 20 years, up to 23 cents from the previous price of 19 cents. That's more than a 20%. I didn't know they sold bananas by the
individually.
Piece.
They sell them individually.
Individual bananas?
You have to wonder if they were treating bananas as loss leaders, if they were using them to bring people into the store. And they must have different margins and must know that people love the idea they could just go in there and grab a banana for 19
So while we
now
have you
23
here,
cents.
and we've got another couple of minutes to chat, what are the big deals that you've got on your radar screen in the media world? Is it Paramount?
Well, everyone's watching to see what's going to happen with Paramount Global and also to see what David Zaslav
does
Warner
with
Brothers
Discovery.
But I also have to say the big deal that is going to influence a lot of these companies is the NBA, because those NBA rights are up for grabs. And this ties into our final story, which is this. Some NFL news.
Oh.
The opening weekend game will be played in Brazil. It'll be streamed exclusively on Peacock on Friday night, September 6th. Now, Peacock was the first to exclusively stream an NFL playoff game last season. So this season, Amazon will get an exclusively streaming game, a playoff game. And there are two big takeaways here about the Amazon and Peacock news. Now, streaming is a huge part of the NFL's future, and Peacock certainly seems to feel like the big money it spent for rights to that wild card playoff game was well worth it in terms of subscriber additions. And of course, we have to note that Peacock is part of our NBC Universal family, the parent company of CNBC. But all this says to me is look for some streamers to be involved in that NBA rights deal as well.
I could not agree more. There's going to be a lot of streamers involved there. Why don't we take a look at where the market is right now? As you see, the Dow at 39,393 down at the bottom of the screen, up just a little bit, 80 points or so. The S&P 500 up 0.5%, and the Nasdaq is higher by about 51 points at 16,435. All right. We will see you when we reconvene here tomorrow. Same time, same place. You'll be here?
I'll be here. Thanks for watching Power Lunch. Closing bell starts right now.
And welcome to Closing Bell. I'm Scott Wapner, live from Post 9 here at the New York Stock Exchange. This make or break hour begins with the rally's momentum. Whether it is fading or just resting and recharging, we will ask our experts over this final stretch. In the meantime, your scorecard with 60 minutes to go in regulation looks like that. We're mostly positive across the board, modestly so as this quarter winds down. That PCE report on Friday looming large, even with the markets closed that day. Interest rates, well, they're mostly lower ahead of that. We'll keep an eye there. 2 years a little bit higher. There's the yield, 4.59. Discretionary comm services, the banks leading the way today in the session. Tesla's up nicely as well, even though it remains one of the S&P's worst performers this quarter. And UPS having a day, well, its worst day since January, as the company reveals its new financial targets. All of it takes us to our talk of the tape. How much steam is left in this record-setting rally? Let's ask Liz Young, SoFi's head of investment strategy, with me here at Post 9. Welcome back. It's good to see you.
Thank you.
You think momentum's fading?
I do think it's fading.
Is that how you would answer that question at the top?
Well, I mean, you can look at it even just in a numerical sense. If you look at factor returns and what's happened and break this rally up into pieces, the first piece of it being October to December, momentum led, high beta led, and then you get into 2024, momentum was still leading but sort of slowing down, and you saw low volatility come in as a leader. You saw some quality come in as a leader, and then in March in particular, you have low vol, quality, value, dividends as the factors that are leading. The one consistent factor that had been leading the entire time and continues to is large cap versus small cap.
Okay, let's distinguish here, because we could take this one of two ways. When we talk about momentum, you were speaking specifically about the momentum trade, momentum stocks like big cap tech and otherwise.
That's right.
I'm more talking about momentum of the rally itself. Do you think we're still cool, or are we fading in that regard too? The momentum behind the rally.
I think the velocity of it is fading, the speed of it, the fervor of it, but I don't think that the rally is ready to conk out. I think that there's still room for stocks to continue this rotation trade. The risk that's presented in the near term is the rebalance that could happen at the end of the first quarter. You've got the S&P up almost 10% year to date, aggregate bonds down 1%. That's a really big spread, relatively speaking. So you might see some of that narrow as the quarter ends, but I still think that there's more room for a rally to continue, just not at the same speed.
I mean, the dreaded April 15th looming too. Right. Tax day.
What happens?
I know. I've heard terrible things. I've heard people talk about, that could be an impetus that you could see some selling in the market. Got to pay your tax bill.
Yeah. I think that happens every year, though. I don't know that that's going to be something that really pushes us one direction.
Well, after
or
a big rally, though, right?
After
that's
a big rally,
the context.
If people took their gains last year, I don't know that there were a ton of people doing that. I think everybody rode it quite a bit. And then we got new money that came in and continued to invest in equities. And maybe some of that rotation that's happened this year that's driven more of the rally into other sectors is people taking gains out of tech. But I think people are trying to avoid taking those big gains.
You're getting into a seasonally good period. I mean, April is good traditionally, according to Ryan Dietrich of CMT. We've had him on. I like what he puts out. Second best month since 1950. Third best over the past 20 years, fourth best over the past 10, fourth best in an election year. So seasonally, you're set up to potentially continue this, and then you obviously have the Fed and these possible cuts starting the summer looming.
Right. Well, I happen to think the Fed is going to be a lot more patient than we originally thought, obviously, but even more so than we think right now. I think that they are going to move much more slowly, and perhaps even more slowly than most other major central banks. And that means that maybe they do start when we expect, but then they keep it on pause from that point, and the whole thing is a very, very slow-moving bowling ball through molasses as they start that cutting cycle. Markets do tend to do pretty well after that last hike and before the first cut. This happens to be a very long period in between that last hike and the first cut. If the Fed makes it to November, it'll be the longest one ever, and it's just going to be this waiting game. So we're waiting for news, waiting for reasons to continue to stay optimistic, and so far we're getting them.
So did you see what Morgan Stanley's former chairman and CEO James Gorman said on this very network earlier today? Because I'd like to read it to you and then get you to respond to it. It's related to the Fed, how many cuts we may get, if any. He says, I wouldn't be surprised if they move in the first half of this year. I wouldn't be totally shocked if they don't do anything. He said, I would be surprised if they move in the first half of this year. I would not be totally shocked if they don't do anything for the rest of the year. What happens if he's right? What happens if they don't do anything for the whole year?
I mean, that's the definition of higher for longer. And I think, frankly, it would help their credibility on the inflation fight, because themselves, the projection that they have is that they're not at 2% by the end of the year. And if the data continues to come in this strong and the labor market holds up, that's them staying true to their word. There's really no reason to cut. And if the economy can withstand it, that's okay. I think that they will start cutting this year. I think he's right about the first half. I'll be surprised if they start in the first half at this point. I don't think that we're necessarily headed for 3 cuts, but I do think they'll start this year.
I mean, June counts as the first half, if technically speaking. So maybe you know, if you get the first one in June and then they sort of see how things unfold. If you get one, you think that's okay? Is it decent enough? I mean, as long as I've heard people make the argument, it doesn't even matter. As long as we know that the next move is a cut, it doesn't necessarily matter when it comes. It's the fact that this regime of hiking the way they did so strongly and so swiftly is over. We know it's over, and that's why the market's been rallying.
That I would agree with that. However, they were late on the hiking cycle. They're probably going to be late on the cutting cycle, but that's because the data is delayed. They almost have to be late. They want to have confirmation of certain things before they feel comfortable starting to cut, so it's going to look like they're late.
Well, and the economy's good, too, right? It gives them a little cushion.
Right. Well, and I would also agree, I don't think that the amount matters. I don't think that it's going to matter whether it's in June or July or if it's 25 basis points or not. It's the fact that they message that they're starting the cutting cycle, and the market will move on that and on that message alone.
Let's go back to where we started talking about momentum, but this time, rather than for the rally, for the actual momentum trade. Bank of America securities, their flows. People keep buying comm services and tech.
Yes, they do.
Tech saw its 4th week of inflows after outflows most weeks in 24, right? So money's coming back in. Comm services, the longest buying streak of any sector, that's 21 straight weeks. So, you know, people aren't willing to give up on this trade, which some, you know, continue to try and declare dead, tired, or whatever.
Yeah, the enthusiasm runs rampant, and I think there's still so much buying appetite and so much risk appetite that anytime there is a pullback, and obviously the tech trade had seen some softness coming into this year, especially compared to what happened last year. So people saw it as an opportunity, and I think that speaks a lot to investor sentiment right now, wanting the market to continue marching forward and being okay with the idea that it's not going to do it at as fast of a clip as it had been before.
Yeah, I mean, I'm looking at sectors, and over at least this month, it's certainly evened out. Tech's dropped back in the pack. It's like 6th. But things like energy, which are the best, utilities have done well. Financials, you know, tech isn't in a slouch, but materials have done well. So it's broadening out. In fact, let's broaden out our conversation. Let's bring in Courtney Garcia of Payne Capital Management here at Post 9, a CNBC contributor too. Welcome. It's good to see you again. What's your view? Are we losing momentum as a rally, or we just good? We're just, you know, rest and refresh?
I really do firmly believe that the markets are going to continue this momentum higher for a couple of reasons. But the biggest reason is the Fed has gone ahead and indicated that they're likely at the end of their hiking cycle, they're going to be cutting, which to your point, we don't know when it's going to happen or how much, but it is on the downwards direction. And you're starting to finally see cash come off the sidelines. This is one of the first weeks we actually saw that huge $6 billion in cash actually finally went down. What you're seeing is people, unfortunately, are trying to chase the rally. They don't want to miss out on this. They're taking that money and they're putting it into tech. So while I do think the tech trade probably is on borrowed time, people are going to continue to put money there, probably at least in the short term. So it's not necessarily where I am allocating money for the time being, but I do think general market, you're probably going to see that continue.
You're just, you know, simplify the whole thing, don't fight the Fed. That's basically what it sounds like, right? Powell was dovish last week at Fed Day. The dots didn't change for 3 cuts coming this year. And at the end of the day, that overshadows and outpowers overpowers everything else?
Yeah, which is almost, it's interesting to me that they were so dovish. Like, I really don't disagree with anything they said. We have a strong economy. We have a strong labor market. Inflation is moderating. Like, they should be cutting later this year. But they're kind of showing their hand early, you know, which is now indicating the markets are going to price that in regardless of it happening or not. And the markets do tend to overshoot these things. So, yes, you kind of do have to follow what the Fed is saying, at least in the short term. But inevitably, it could affect them cutting later because they could inevitably be having additional growth in the economy just by indicating they're probably going to be cutting later.
Have you ladies respond to Goldman's chief equity strategist, David Costin, this morning on SOTS. He said the market is flat from here to the end of the year, 5,200. That's the target. That is expectation. You have modest growth in earnings, 8% looking into this year, 5 or 6% into 25. That's the trajectory of profits. Is that good enough? 8% this year, 5 to 6% next year, Liz?
Dude,
I mean, that would be
who is saying that we're going to be flat the rest of the year?
Rarely do we actually hit average on the nose.
Who is this person?
I'm guessing. I don't want to put words in his mouth.
Austin is saying market will be flat into the end of the year. We got an election coming up. What is wrong with this person?
A little bit more bumpy than what that would suggest.
Yeah, he's already had to raise his target on the S&P a couple of times. Everybody has, right?
Can you imagine flat into the end of the year? I mean, I can see stable sideways and up as part of summer. That's normal every summer you do that, but you're telling me that we're going to be flat in the fall, like late summer and fall for the election? That would be like the first time ever, right, in modern history?
Especially if we do approach a cutting cycle.
Give me my 40 fucking handles.
What the data looks like as we approach that cutting cycle.
Give me my fucking 40 handles to the face.
Maybe they're cutting because things are cooling too much. The other
I'm not in puts. I'm in calls, tons of them.
Right now.
I just added some more calls too.
Sectors, utilities, staples.
I'm like boatload. I got a boatload of calls.
I think right now that trade is about dividends. I don't think it's about fear. But
I mean, dividends preparing for the fact that, sorry, I'll come back to a sec. Preparing for the fact that yields are going to continue to go down because the cutting expectations go.
Who is this person? Yeah, the guy's got to have. Oh, you mean this guy on CNBC they're talking about has puts? He has to. Flat sideways. What the fuck you saying? Fucking liar.
That if defensive sectors are catching a bid, it's because something is going wrong. The market is.
Yeah, that guy.
I think the market is trying to.
Look at this guy. See, they're talking about this guy on CNBC said. He had to adjust his upside target twice already this year. What's his next target? Flat, sideways the rest of the year.
So where are you? What looks the best?
Yeah, and we've been
Butterfly expires in December.
Technology is definitely a part of our
5,200.
Our best performer over the last year and so far this year. But we've been making sure that with new cash, we're
going to close the year at 5,200. The year's over.
Energy has been a really good trade this year, and it's not that we had this gifted insight. It's just a valuation trade. I mean, things were a lot cheaper. You're going to see things broaden out.
Well, we're going one way or another. Well, there's a. I shouldn't say that. There's a.
Does continue to do so.
There's an extremely high probability. An extremely high probability of us going up really high or down really low for about a week. So someone's going to be right. It's just like I posted on, I was on Twitter and we came into the seasonality calendar, like came into right where the market should drop. And I was like, someone's getting hurt here. It's either going to be bulls or bears, but someone's getting hurt here one way or another. And we're at one of those moments right now. We're at one of those like moments where someone's going to get fucking torched. It's either gonna go way up or way down, and it's gonna last about a minimum 2 more days. They're gonna park this thing, and then we're gonna go into the beginning, the first week of the month, and find out what they really want to do. Do they want 5,000 for their end of month targets? Do they want 530, 535? I'm of the belief right now that we're going to 535, but 530, 535, 525 today would be nice. But nobody knows here, so we'll find out. This happens most end of quarters, so you can actually see it in just the price action here. They get their cards close to their bodies. I just had some calls for the fucking first week of fucking next week too, so I'm on this fucking upside move here to 535 and then 550 too, so we'll find out what they're doing. I don't believe they were running. I saw Vol Signals this morning was talking about pensions trying to exit the market. We were discussing the other day. GS released that data. There was like 2 groups. I think it was pension funds and some other fund. They're up historic highs, and so there's an idea here that they're going to exit the market. But then there's like institutional investors are just coming into the market finally, and retail investors, I guess, haven't come into the market either. There's a lot of people that have been sitting on the sidelines. So the question becomes, does that offset? There's like pension groups and one other fund group that's looking to exit the market. But there's like a ton of other money that is looking to enter the market at the same time. So do we get the springboard off of 5,200, 5,000 to the upside, or is it like, oh shit, we're all done for the year? So place your bets, boys and girls. Buy yourself some cheap ass puts, some cheap ass calls on both sides. You can catch both sides of this ride. I'm interested to see which way we go. Is it up or is it down? Where we getting the blood show? If we get that's the other thing too. If we get the blood show into the close, let's say we get the blood show down. If we bounce back up at any point, I'd be looking to short that tomorrow and send this market even lower. We should start a downtrend for a few days. So I don't really, I mean, I guess I do care because I am long as fuck here for the market, but if it does reverse to the downside and we start selling, start ramping to the downside, let's do it. I don't really care at this point. I just want something to happen. I want some moves. You know what's funny too, or not funny, but days like this will happen this summer. If you guys don't, some of you guys know that, some of you guys don't. We'll just be sitting here fucking sleeping all day long and fucking drinking margaritas, getting shit-faced, waiting for the market to move. 2 or 3 days of consolidation, one quick move into the weekend, and then we do it all again the next week. I'm going to turn this back on. I got to get right back to it. Give me right 1 second, right back with you guys.
June 10th, that's when WWDC is going to happen. And now this is the event where Apple typically introduces the latest software for its gadgets, like the iPhone, iPad, or Mac. Sometimes even new hardware, like the Vision Pro that debuted last year. You were there with me, Scott, when that happened. But this year is going to be even more important because we're expecting this to be when Apple makes that AI announcement it's been teasing for the last several weeks. Let's give you some evidence here. Look at this tweet from Greg Joswiak. He's Apple's marketing boss, teasing a, quote, absolutely incredible WWDC. He did the Trump thing and capitalized some random words, A and I capitalized there. You can figure out what he means. Apple's put enormous pressure on itself, though, to, as CEO Tim Cook has put it, quote, break new ground in artificial intelligence. Now, the company doesn't have a clear AI narrative quite yet, instead pointing to past products and recently renaming them as artificial intelligence. Last week, we learned Apple is also in talks with companies like Google and China's Baidu to use their AI, at least in part, for whatever new AI features Apple plans to reveal. And we may learn the extent of those relationships at WWDC. And of course, like you hinted, Scott, lots hinging on that announcement. Bullish analysts out there believe this will be the event that starts the turnaround for Apple's tough year so far. Apple has high expectations to meet, and it set some of them itself. Meantime, Apple's down about 11% on the year, and of course, lost that top market cap spot to Microsoft, Scott.
Well, they want to be talking more about the letters AI and not so much DOJ, right? They need to steal the narrative back.
Or DMA. All these headwinds they're facing in Europe. There's that challenge to their adherence to the Digital Markets Act in Europe that we got yesterday. That could force them to make more changes to their services business over there. And open it up to more competitors. So yeah, there's a lot going on that could distract them, but this is going to be the AI event, it sounds like.
Yeah, we're wrapping up the quarter. I'd be remiss if I didn't ask you just your thoughts about what the stock has done as really a sore thumb in the mega cap trade. It's down 11.5%. On the quarter. It's just not that often that we're sitting here talking about this stock as such a dramatic underperformer, are we?
Yeah, and relative to its peers, it's been the leader. Keep in mind, Scott, it started this year as the most valuable company in the world. It gave that up to Microsoft. The gap between those two companies just keeps getting wider and wider. And part of it is just, smartphone demand and the problems in China with demand just plummeting there, not to mention the resurgence of Huawei, renewed competition there. And then, of course, like I keep saying, the question around AI, what does that look like? And then if we extend it out even further, the next iPhone, what can they put in that next iPhone that is unique to it, some kind of AI special feature that's going to cause people to want to upgrade maybe before they would normally be ready. So those are all lingering questions, hanging on as we get to WWDC, Scott.
It's going to be exciting. Appreciate you, Steve Kovac. Thank you very much. Let's send it now to Pippa Stevens for a look at the biggest names moving into the close. Pippa.
Hey, Scott. Shares of Trump Media and Technology Group, the company behind Donald Trump's Truth Social platform, surging today in their debut on the NASDAQ. The stock, which is trading under the ticker DJT, jumped as much as 50% earlier in the session. The former president owns at least 58% of that company. And a roller coaster ride for shares of International Paper, hitting a 52-week high before turning negative after DS Smith confirmed it's in talks to be taken over by International Paper in an all-share deal. The move could start a bidding war after Mondi submitted an offer earlier this month. That stock now in the red today. Scott?
Pippa Stevens, thank you very much. We're just getting started here on the bell. Coming up, what's next for this record rally? Top technician Jason Hunter is back with us and why he says he's suspicious of the momentum. Plus, the sectors he thinks will see some serious strength ahead. That is right after this break. We're live from the New York Stock Exchange, and you're watching Closing Bell on CNBC.
I just deleted a whole bunch of stuff by accident. I'm in so much trouble. I was trying to delete a bunch of charts and stuff from I've got it's almost like a downloads folder. And I think I deleted a bunch of shit I wasn't supposed to, and I just went, oh shit.
I'll try it.
Welcome back. Stocks in the green across the board. The S&P tries to rebound from back-to-back losses, and my next guest calls the rally broadening suspicious. Says now's the time to sell the breakdown in crowded momentum groups. Let's bring in J.P. Morgan's Jason Hunter. Welcome back. It's good to see you.
Oh, thank you very much. Great to be back.
Let's start with how the rally looks to you overall? As we're about to close the quarter, we're on like a 5-month winning streak for stocks. So how do we look?
Yeah, so it started out as a very thin rally, and mostly the big mega cap tech names that led the way. Those have paused for the better part of the last couple of weeks. And what's taken the leadership in a way has been the deep cyclical, so industrials, materials, energy, and financials. And that coincided with a sharp lift in commodity prices, industrial metals, and the energy sector as well. Like we put in our note that we just published this morning, that seems suspicious in terms of the timing. If you look at the shape of the Treasury curve, we're able to do analysis and comparative analysis of the U.S. manufacturing cycle, going back to the early 1960s and the shape of the, let's say, 3-month, 5-year curve. And with that curve more than 100 basis points inverted, history suggests it's going to be very hard for a manufacturing cycle, or a substantial one anyway, to play out from here, which is really what those deep cyclicals need to continue to rally from here. So, like I said, the broadening of the rally from a pure technical perspective, if you're looking at market breadth, that's what the bulls want to see, but we're not quite sure, we believe what's going on here with the rotation.
I mean, those who've tried to make calls based on history have had their calls run over by a herd of bulls. Throughout this whole period, it feels like. Well, history suggests when the Fed does this, the economy does that. History says when you have one big group leading for some time, it's unsustainable, the market rolls over. None of it's happened.
Yeah, I mean, you could put us in that camp as well. When you think about the long and variable lags of an inverted yield curve and the transmission mechanism to when that finally starts to get priced into equities and equities start to think about risks going forward for the broader economy. We ourselves in the technical group here at JP Morgan thought that would have happened sooner. And the reality is, ever since the S&P pushed above the 4,400 level, we've been skeptical, and here we are, poking at the 5,200 and above area. It's the long and variable lag period. The economy has a little bit of hang time here over the last few quarters, and we've paid the price for that when doing the comparative analysis. But again, if you look at even in the post-1980 world when the lags were, longer and far more variable than what you saw in the pre-1980 cycles, 22 months after the 3-month, 5-year curve inverts, that's typically, on average when you've seen the data finally start to inflect lower in the economic data, that would put us roughly in August of this year. And markets in theory should lead that by, 1 to 2 quarters. So can it stretch longer than that? Sure. That's what, what we basically have done is say, look, the momentum's strong, stop trying to fight the trend, go to a neutral stance. And right now we've kind of have this 2-prong approach. If the leadership, the heavy momentum names start to break down and, coincidentally, the 50-day moving average sits at those pattern support levels. So it's a nice, easy number to look at for something like the NASDAQ, S&P 500, or the Philadelphia Semiconductor Index. If those break to the downside, you follow that and you go short and put a tight stop. And on the flip side, if something like the Russell is going to start to break out, small caps are usually the last to go in a PMI cycle or in a manufacturing cycle. There's a lot of catch up there. While we're skeptical of that, we would just follow suit. And let's say if the Russell breaks above 2150, you start stopping into exposure on the long side and put a stop under that. Again, that's our risk scenario. Mm-hmm. We find it hard to believe that unfolds. But as a technician, if it starts to break out, go long and try to stop underneath it and see what happens.
Yeah, no, I sincerely appreciate your contrition on all that. I think a lot of technicians have been caught under a steamroller to this rally. It's been confounding to some. You mentioned the momentum in the mega caps stalling or looking like it's, fading. Pausing is not necessarily a bad thing for a trade that was virtually straight up, no?
Yeah, that's right. And that's like normally when we see this type of deceleration in a trend, particularly with the yield curve that's inverted, that's usually a time where we'd get aggressive and say, okay, go short, don't wait for the breakdown, get ahead of it, and don't give up that 3 to 5%. But because the momentum has been so powerful since the October lows, and we've seen this deceleration and reacceleration without breaking support for, let's say, at least 3 times, since early December, we want to wait for the breakdown at this point or a broader distribution pattern to form. Neither of those are on the cards right now. So at this point, you respect the momentum and, kind of stand aside and wait for the market to do something wrong before you try and go after it from a bearish perspective.
Yeah, I mean, from a historical perspective, I know we sort of threw a little cold water on looking at history and trying to determine trends because this market's just different. But April is traditionally a good month for stocks. I cited all the stats at the beginning of our program about how traditionally well this month is for the bulls.
Yeah, I mean, you can look at those seasonal patterns. The main problem that I have with those types of things, the error is usually a multiple of the forecast, so it's really hard to go along with those sorts of things, particularly after the size of the rally that you've had here. Like I said, we're not bullish by any means. We'd only buy a breakout in small cap. But yeah, the seasonal patterns are what they are, and as you referenced, April is usually to the upside.
So you'd buy the breakout in small caps if it, I mean, there's been fits and starts, and it's been hard for a whole mass of people to get behind that trade. Some suggest, well, you got to wait until the Fed actually starts cutting. But if you do see a breakout, you'd be a believer. Yeah, and I think there's two reasons there. Like number one, if there's a PMI cycle, the last time you've had small caps underperform to the extent they have, and the PMI data's lagged some of the leading markets like semiconductors or European autos, that was 2012 after the Euro sovereign crisis and the U.S. debt situation. Small caps had a multi-quarter period of tremendous outperformance as the PMI data and manufacturing data actually started to print well. Like I said, I think that's a low probability outcome. But on the flip side of that, along with the bullish mega cap momentum trade, if you look at the long short community, that in part has gone hand in hand with underweights and shorts in small cap, high beta, low quality. And Dubravka Lekos and our team here, they published a fairly sizable piece on this a couple of weeks ago, where you have so much crowding into that trade structure that you could get something of a momentum crash in either good news or bad news, where large cap underperforms and small caps outperform in a sizable way. Jason, we'll talk to you soon. I appreciate your time very much. Thank you. Jason Hunter, JPM, as you see. Coming up, trading the tech strength. Peter Mallouk from the top-rated firm Creative Planning is here with his forecast for the sector. And the one mega cap name, singular, he thinks could have some issues ahead. And a quick programming note. Tomorrow on Halftime, speaking of tech, a CNBC halftime exclusive, Altimeter Capital's Brad Gerstner. All things tech plus big news on his Invest America initiative as some of this country's best-known CEOs have joined his council. Don't want to miss that. Closing Bell is coming right back.
According to the USTR office, United States mission to WTO received a consultation request from China regarding parts of the Inflation Reduction Act.
So we are heading down into the close right now. They're going to blood the fuck out of this to the downside. You're going to get a pretty nasty move down here. Right now it's 332. Right to that 1:30 in the afternoon, we should blood this straight down and then ride it back up into the bell. And this will continue into tomorrow. This is the direction. I'm going to get really bearish here into tomorrow now at this point. I want you to check the Discord for the charts that I posted on March of 2022, Q1 end of quarter.
Do you want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service for the price of 1 month. and saved 92%.
As other people.
Welcome back. Tech is one of the top performing sectors this quarter, with the space hitting a record intraday high again today. And while our next guest is bullish on tailwinds from AI, he does see some potential issues ahead for one of the group's leadership names. Joining us now, Peter Mallouk, the president and CEO of Creative Planning. It's good to see you. Welcome to Closing Bell.
Hey, it's great to be with you.
So obviously jumps out to me first on the list of the things you say you don't like within tech. NVIDIA is on the list. What?
Look, tech's got a long way to go. A lot of people, clients ask us, well, how long is this tech rally going to continue? And I tell them, for the rest of your life. I mean, we're in the middle of a revolution, and we're in the middle of an AI revolution, and chip makers are going to do well for decades. But with NVIDIA, I don't know when it's going to pause, but it is going to pause. And what is different about NVIDIA is I would not equate it to Apple as a company that has a significant moat that's going to protect it for all time. I would put it in the same boat I put a company like Netflix or Tesla, which is just an incredible company. It's an innovative company. Who knows how much longer it has to run? But it doesn't have a moat, it has a head start. And those are very, very different things. And companies with a head start, the market eventually catches up with them. Yes, the AI revolution can continue, but that does not mean all the eggs should be in the NVIDIA basket.
But if you have the best and most powerful component that seemingly almost, and I'm putting this in quotes, everyone needs,
yes.
That has to be a bit of a moat, especially if you incorporate the head start you suggest. The amount of money they're able to charge for the transformative chips that they have, it has to be a little bit of a moat somewhere, no? I mean, come on.
Yeah, I would say everything you said is correct, and I would add the words "for now" to the end of it. Yeah, everyone needs it. There's not a lot of alternatives. The competitors are going to get started. You've got the AMDs of the world, Intels of the world, but you're also going to have these other players like Oracle that are coming. There's going to be all kinds of companies that are going to come into this space. They are going to be successful. They're going to figure it out, and they are eventually going to catch up. And when we see that, this sales to earnings ratio is going to come back down to earth. That might be a couple years. It might be a couple months. I'm not big on timing the short run. The space is for real. This company is for real. But at some point, people are going to regret if they've got all their eggs in one basket. I'm all for having it as part of an index or having a significant position as part of your portfolio as a bet on this space. But look, I've seen a lot of people that have come to us. This is 20, 50, 60% of their portfolio. They think it's the new Apple. It's not the new Apple. It's a leader in its space. It's innovative. It's an incredible company. But Apple does not have competitors that are real competitors that really threaten its business enterprise. NVIDIA has real competitors. They're going to catch up in a few years. We're going to see a lot of them emerge and be successful.
Do you guys own the stock?
We do, because the largest part of most of our clients' portfolios is index-based. It's one of the largest performing positions, for our clients that have that large cap position that most of our clients do. They've reaped a lot of reward from NVIDIA. We've seen these big tech stocks lift up, for example, the S&P 500 year over year over year, where everyone says, well, the S&P 500 is terrible except for Apple, or the S&P 500 is terrible except for Facebook, and this year it's terrible except for NVIDIA and a couple other names. Well, that's the point of owning a diversified basket of large stocks. About 30-40% of it's going to be technology. And these winners, a loser can only go down 100%. A winner can go up 1,000%. That's kind of the whole point of taking that approach. You don't have too many eggs in one basket, but you're still participating in the upside when these runaway companies happen.
One of the eggs in the basket that looks to have cracked of late is Apple, since you've mentioned it comparatively to NVIDIA. But you do like that stock here. Tell me why.
Well, I love Apple, and I love it all of the time. And I think it's because if you went to the average American that has an iPhone and says, for the rest of your life, I'm going to take your iPhone away or one of your fingers, the majority of them are going to say, here's my hand. Go ahead and take a finger. This company has a real moat. There is no real competitive threat to Apple. The only risk Apple faces that I think is serious is regulatory risk, but even that is going to be muted to some degree. So it's going to have its headwinds like it's facing now. But if you told me I had to own NVIDIA or Apple and wake up 20 years from now, at which one will have done better, I'm going to take Apple.
We'll leave it at that. Stock's at 170. And some people think may go lower than that. We'll see. Peter, it's good to have you on the program. We'll talk to you soon. Peter Mallouk joining us here at Closing Bell. Up next, we're tracking the biggest movers as we head into the close. Pippa Stevens is back with that. Pippa.
Hey, Scott, an experimental pill could tip the scales for one weight loss drug manufacturer. We've got the details coming up next.
Just shy of 15 minutes to go before the closing bell. Let's get back to Pippa Stevens for a look at the key stocks she's watching. Pippa.
Hey, Scott. Viking Therapeutics is surging after the company's experimental weight loss pill showed positive results in a small study, and it will enter the next stage of development later this year. The stock more than quadrupling year to date amid momentum behind the weight loss market. And McCormick jumping after the spice maker beat top and bottom line estimates for the first quarter. CEO Brendan Foley saying on the call the budgets are stretched and higher inflation in the food service channel means consumers are eating at home more, which is helping the company's bottom line. That stock up 10%. Scott?
All right, Pippa, thank you very much. Still ahead, shares of UPS are sinking today. We're going to break down what's sending that name lower and bring you comments from the company's CEO. Closing bell. We'll be right back.
Gender gaps in the venture capital industry are still massive. In the U.S., women comprise about 11% of investing partners. And last year, female founders secured just 2% of all venture capital dollars, while co-ed founding teams secured 21%. So over 3/4 of all VC dollars go to male-only founding teams. For Women's History Month, I'm Julia Borston.
Do you think they're going to blood this bad boy down straight down to 5,200 or not? I think that's 5,200. Let's take a look right there. Let's take a look right there. We got more down to go right here. Whole bunch more. They're probably going to take this right down, all the way down here. S3. 517.93. Woo! We're not done going down. We're likely going to blast this straight down, hit this target right here. I think it's 5,200 on SPX. We'll watch it closely. I'm going to leave on the bottom chart down here. I'm going to leave the bottom chart for SPX Gamma down here. This is that 5,200 right here. This is local support. Funds become CTAs and vol control funds become sellers under 5,100. Just volatility here. That's it. This whole zone right here is all like volatile zone from here. I think it's like here to here is volatility. It's all volatility. Then below we become actual sellers of the market. It gets really nasty down here. They'll take that shit straight down to 4,900 if you get underneath that 5,100. It's not lower than this. This is 5,200. 5,100 is like way down here. Oh, yeah, baby. That's S5 and S4 down here. 517.09, 516.25. And there's a high probability that whenever this selling is done today, this will come back up. But tomorrow we should sell the entire day, all day long. If we follow that March 30th, 31st of 2022, they will sell down the entire day tomorrow. It'll come back up in the overnight, and then immediately on the opening bell, they'll start selling it straight down. And I would expect that at this point, people are going to load the fuck short on tomorrow's opening bell at this point. This is not good If you're a seller, we're not done selling. We're probably not done selling tomorrow at least. So any pullbacks up here, even if we squeeze higher into the close after the bell, they will sell the entire day tomorrow, right off the opening bell. If history is any kind of an example of this.
For more information on that call. Up next, your GameStop setup. That stock has had a rough run, falling nearly 40% over the past year. So is a turnaround in the cards? And do not miss an exclusive interview with the chairman and CEO of Adobe. That's coming up at 4 p.m. Eastern in overtime. Closing bell. We'll be right back.
Market on close imbalance, 4.9 billion to the sell side.
We're now in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down the crucial moments of this trading day. Plus, UPS heading for its worst day in 3 months. Frank Holland has those details. And Steve Kovac looking ahead to GameStop results out in overtime. First to our senior markets commentator sitting next to me. What's on your mind today?
Well, it's hard to draw any significant objections to the way this market is acting. It's just kind of low volume, low volatility drift at the end of a quarter, sitting less than 1% from the all-time highs, kind of sealing the books on a very strong start to the year. That being said, I have a hard time not looking for what can possibly be standing out as less than strong. One thing is, this is the fourth kind of exhausted sagging close in a row. Maybe that's just the sort of rebalancing out of stocks into bonds that happens in the absence of other macro effects. And it's also tough. I just find personally it tough to just stick with a market where your main advantage is not overthinking it. Your main advantage is let the market just keep kind of grinding on the same positive news flow and macro backdrop. I find it more comfortable when it's climbing a steep wall of worry. There isn't really a steep wall of worry anymore. A few months ago, you could say everybody thinks the Mag 7 is everything, and everybody thinks if two of those stocks fall apart, we're in trouble. And I was able to say, no, I don't think so. It could be more nuanced than that. And similarly with the Fed rate cuts. Now everyone is on board with it's okay if we don't get rate cuts soon. So I'm just in that mode of seeing give due respect to the trend. There's nothing that's remotely close to breaking the uptrend, but be aware that this is when unexpected stuff happens.
I mean, the overthinkers have been run over.
That's to a large degree. I'm talking more in the last few weeks.
Yeah.
You know what I mean? When it started to seem like this complete lack of a 2% pullback in 5 months starts to get extreme.
Well, let's see what happens with the PCE. Now, I know we're not going to trade it on Friday, but Monday's going to be interesting.
Look, and I'm willing to completely concede there's definitely upside risk to the PCE, too. I mean, if that's really tame and all of a sudden it looks like Powell nailed it by just sort of not budging on the 3 rate cuts and all the rest, then, there's one
clear for
less
takeoff.
Perceived impediment gone. Yeah.
Yeah. Keep watching the mega caps, too. I mean, that trade, there was a moment today where many of the mega caps were in the green. And now we're in a scenario where many now are in the red. Sure. Tesla's come off its high, too, as we're...
That's because all the energy is in, the small, fast-moving, exciting, speculative stuff today. So maybe that's taken some strength away from NVIDIA.
All right. Not so special delivery today, Frank Holland, for UPS. What's driving this stock sharply lower?
Well, Scott, this UPS stock decline today, it kind of came in 2 waves after it opened fractionally higher. The first, when UPS said in its own presentation that the parcel shipping market here in the U.S., it currently has the spare capacity of 12 million packages per day, raising a few eyebrows about UPS's ability to hold pricing and grow margins. And then second, where the company said that Q1 EBIT would come in lower than the first half estimate, also leading some questions about exactly how the company is going to achieve targets not only long term, but in the short term, leading to levels that we're seeing right now on pace for its worst day since earnings. UPS CEO Carol Tomé appeared on CNBC earlier today discussing the current demand environment.
We did see volume leave us during the contract negotiation, and more than we expected, candidly. But I'm happy to report that we have brought 60% of that volume that diverted back into our network. And it's not just about winning back, it's also about winning new. We do believe that volume will be down in the first half of this year, but we expect it to return to growth in the back half of the year.
So I spoke with a number of analysts. They found the targets that UPS put out to be, quote unquote, aspirational. Others saying the outlook seemed to depend on a Goldilocks scenario, not only for UPS, but for the entire U.S. economy. B of A analyst Ken Hexter out with a note earlier that really captures some of the skepticism, saying in part that the 2026 EPS estimate is 20% higher than their numbers, also citing UPS missing the targets they laid out at their last Investor Day. Scott, back over to you.
Frank, quickly, I mean, why such a discrepancy between the performance of FedEx and UPS? It's not even close.
Yeah, I mean, a lot of speculation about that. I know what you're saying. FedEx shares up about 2%. Right? So, right, yeah, FedEx shares about 2% right now. You see where UPS is right now, so big difference there.
I'm talking like month to date, year to date, quarter to date. It's not even close.
Oh, well, I mean, you have to remember, January 30th when UPS had its last earnings. That's the last time it had a day this bad. I believe they missed volume by about 10%. They were 10% below estimates. A lot of questions about exactly how they're going to work off this Teamsters contract. They said it was kind of a barbell thing. They were going to see the impacts in the beginning. In the middle, they would see some easing of cost pressures and then have to pay some more at the end. But at the same time, they're trying to cut costs. So they're paying more for labor, even though it's in the front end, as they said, and they're also trying to cut costs. They're just kind of missing the mark in the eyes of analysts and obviously investors a bit.
All right, appreciate that. Frank Collins, Steve Kovac watching GameStop. Earnings out in OT. What do we expect?
Yeah, not a lot of visibility into everyone's favorite meme stock here, but what we do know is there's some data from over the holiday quarter that video game console sales have kind of softened a bit. We heard that from Nintendo. We heard that from Sony, so we can see how that impacts sales over at GameStop. But look, this company doesn't give guidance or anything like that. They don't even hold a conference call, so unclear really what to expect beyond just some softening demand in video games overall. So we'll see what the results happen after the bell.
All right, we'll look forward to that. Steve Kovac, thank you very much. Heard the sound effect marking the 2-minute warning. Yields mostly lower on the day. They've been a pretty tight range here as we wait for Friday.
Yeah, that's been a comfortable situation where yields kind of came back off the highs. They've managed to sit around there. Not a lot for them to react to. We mentioned earlier the Philly Fed kind of soft. The economic surprise index has sort of rolled a little bit toward moderation. So really, that's fine. That's why I think the macro stability is allowing people to do other things like buy Reddit. You know, I mean, Reddit's like one of the top 12 most active stocks and options on the Interactive Brokers platform 4 days into its history.
Well, it's up 40%.
And obviously we got the DJT. So it's sort of the fun part of the market where the stakes are low in terms of real world, but they're high in terms of, you know, risk reward on a short-term basis. That seems to be where some of the energy is flowing. I'm not one to like look at people doing the speculative stuff and start to scold and say this means the market's topping. It really doesn't. Usually it's a bull market kind of behaving like a bull market, but it's notable that you're starting to see other names being taken up in that current.
You use the word energy, talk about something else, obviously, but I look at energy. It's obviously had a really good month, up 8%. It's been the outperformer. We'll see if that trend continues.
Exactly. So there's this sort of reflationary moves going on.
Woo!
The market in general.
Smoking down there right now. Are they gonna keep setting it down or not?
Equal-weighted techs underperformed the market this month. The money's kind of flowing elsewhere for now.
Sometimes you get a little excited.
Yeah, they jump the gun a little bit.
Woo!
Sometimes they get a little excited.
Blasting it. 4 p.m., baby.
I'll see you tomorrow.
Well, I should leave that for 4. I'm going to put this one back over there for 4:15. They should pump this back up right now into 4:15, and then they'll trade it sideways and then down into tomorrow. Whatever pump comes up into this will be sold or should be sold on the opening bell tomorrow. Huge down move today. Huge down move. Look at that down move up there. No 30 handles for the Bulls today. Straight bloodbath. If you took a strangle or a straddle into that close, congratulations. Hopefully you were not trading futures long as a bull, or else you're scared shitless now probably.
Just gave overtime before the call.
There should be major selling tomorrow, like big selling. If you go in the Discord, I posted earlier today. You know what's really funny? Hold on, I'm going to turn this shit off. So, Volatility Wiz today sent out a newsletter, and I sent him an email afterwards, and I was like, hey, man, you might want to look at this. I'm like back in March of 2022. I remember we came into an end of a quarter. I was like, and we fucking sold. And this price action the last 2 days looks like it. And he looked at it and he's like, oh, that'll be bad. I'm like, oh yeah. And that's exactly what they just did. They just literally traded us exactly like they did on the March Q1 of 2022. So hopefully you're either in puts or that you were in straddle or strangle of some kind, or you were at least made aware that this could take place. Now, this could have happened up or down. It didn't matter which way it was going to go. Don't feel like you had to call it up or call it down or anything like that, but it made that move. Now, what's fascinating here is this should continue. This shouldn't end. This should be like, we should come up in a futures here. We should actually trade somewhere up in here. And then immediately on the open tomorrow, like fucking blast it straight down to the depths of hell. I would expect us to try to trade. Where are we at here? Give me a second here. I'll look. I would expect like 52.12, and then I'd have a target down below 5180 for tomorrow minimum. And if we trigger CTA, and if we end up now just hitting 5180, you don't trigger the CTA selling. But if we start rejecting 5180, we're gonna have a fucking bloodbath. You'll see us go down, I don't know, 490 minimum. 490 minimum, guaranteed. So as of right now, we're still in a pullback mode. We're still not even near. I want to show you one more thing. Let me scale out a little bit here. So get easy there for a minute. All the bears probably freaking out right now. Hold on one second here. Move all that. And then 30-minute chart. We're still in a pullback. So remember, this is about, let me go over to the trigger screen. So in a post last night, I wrote, so just scale out for a minute and get easy. That was a nice little blast, but chill out. So before you get all bared up and stuff. On a 30-minute basis, right, we're still on trend. This is still a pullback. You need to come down here, right? You need to get below that 510. Tomorrow it'll be about 512. So right around that 512, right? Next 2-3 days. But then you have to reject. If you can reject and get the new low right here, we will correct to the downside. But otherwise, just expect the selling for now. Don't get all freaked out and be like, oh, dude, Cap said we're going to crash, that kind of stuff. Don't get crazy yet. We're not in crazy mode at all. But this does signify continued selling, or at least historically, continued selling for at least 1, 2, 3 days or sessions, and a bloodbath coming down here. And I would not doubt that we will take this entire move at this point, and we will even likely try to trade down into this one day, 2 days, 3 days, 4 days. So this puts us like sometime into the beginning of next week, right? Now, no guarantees in this. Don't be like, hey, Cap, you told me we're coming down here no matter what. No guarantees on past history. But, dude, I'll tell you what, that chart, man, I was looking at that chart today, and I was like, so I'm in a meeting earlier, right? And I'm like, hold on a second. I was like, this shit looks exactly like a quarter that I remember, like 1 quarter. And fucking A, man, if it wasn't. So we'll see if this continues on. I'll see you guys tomorrow at 9. I'll have a market brief out early today for you. Don't get all crazy yet. Scale out a little bit. 30-minute. We got a 30-minute chart right here. And we're not even in the dip buying phase yet for a pullback. Like, these are all pullbacks here. Pullback, pullback, pullback. That's all that is right now. We're on a 1-minute chart watching us blast down like crazy. Just cool it out. We didn't get down too much. But I do right now, as of right now, if you had to ask me what I think is going to happen, is let's take a peek at it right here. What I think is going to happen is you're going to see futures pull us back up, right, to about 520. We will reject this right here. I said 520. Maybe it isn't. Hold on here. The expectation would be come right back up here in futures, right? Whoop. And then we're gonna do some continued selling into tomorrow. So I'll be looking for tomorrow. Hold on here. On the opening bell, to reject 519.64. If we can reject 519.64 on tomorrow's open, if that's possible, if we wake up tomorrow and we like park it right here, and they start selling this, and we get a new low right here, we will sell the whole fucking day. Boom, straight down. So I'll have a market brief out for you tonight if this does take place. If you made a bunch of money today, congratulations, and I'll see you guys tomorrow at 9:30 in the morning, baby. One programming note. If you are on the website right now, I made a big mistake today. I ended up deleting well, let me explain this before I go. So I deleted one chart. We had a bunch of charts and shit for like months in a database, and I was like, this is too much shit in the database. I'm going to get rid of it. So I deleted one chart. It didn't affect a post, and then I deleted them all, and we lost a bunch of posts. So I'm trying to repost charts right now to any posts that are on there that are missing them. So that's a part of the work that I'm doing in the background right now so that you don't have any loss of service. So I apologize for that. They will all be up and fixed by tonight. I'm going to keep working on them right now for you and make sure that there's no loss of data and all that kind of stuff. I'll see you guys tomorrow at 9 a.m., baby. And I'll make sure I'm here for like early tomorrow to see the price action if we're going to sell the open tomorrow. Take a look in the Discord. I posted the chart that was from the Q1 2022 Q1 2022, the last 2 or 3 days of the quarter for the month, for March 30th, 31st.